Hey, good morning, everyone. Thank you for joining us again for our Ask an Economist and get a recent update on what's happening. I will turn it over. Dr. Eiler, it's all yours.
Thanks, Vicki. Folks, thanks for joining us today. Remember to use the chat functionality in terms of asking any questions you may have, and we'll try to get to it at the end. And I hope everybody's safe. So folks, here's an overview. The data on November has come out. So in looking at what this quarter has evolved so far, so since September, well, not since September 2019, it should say September 2020, but the bottom line is in November, the US economy had 6.7% unemployment and about 9.18 million people are still out of jobs at the non-farm level by the end of November. For California, it's about 9.3 1 month before. 9.3% unemployment after seasonal adjustments and about 1.37 million people out of work in terms of non-farm jobs from the previous year. Now, we saw a little bit of flattening in November for the US economy. It suggests that California will also be flat when the numbers come out in about 10 days. We're watching this very closely, and I'll show you some data that may help provide some foreshadowing of what's happening in California. But the stay-at-home orders that now have gripped most of the state and are likely to grip the remainder of it in the next 7 days or so will definitely slow down recovery for the short term. The key is whether or not it upsets the apple cart in terms of going forward into 2021 with relatively strong structural momentum. But I'll come back and talk about structure in a minute. Forecasts are moderating a bit. Part of it is that we haven't had a second fiscal stimulus package, and while Congress is seemingly hard at work trying to nail that down since the Thanksgiving holiday, they also have to fund themselves primarily by December 11, by the end of this week. So the supposition is they're going to try to get the job done on both sides, finance the government core and also provide a second stimulus package by the end of this week so that they all can go home for the holidays, which is generally, they should have been already gone for this time period until after January 1st as it is. But there's a lot of political pressure brewing, especially with the Georgia runoffs on January 5, to try to get something in place as a way of showing that a deal can be done. We will see. The second thing about those forecasts moderating is that we're seeing an uptick, as you know, and California is a microcosm of this, and the total uptick in the volume of new cases and how that's going to affect the economy has led to more uncertainty. Now, our financial markets have flattened a little bit, not a whole lot yet. I think a lot of it's because that's priced in what was going to happen. The science told us this was going to happen. We're now going through it. The trick is the volume. It's not that it's happening, is the volume and the magnitude. How long is it going to last and how big is it going to get? And so you're probably going to see forecasts continue to moderate a little bit, and hopefully we won't have deep equity or housing market problems as a result of what happens over the next 4 or 5 weeks. I'll talk more about that later as well. So what am I watching? We need to get through January 5 because hopefully we're going to get a deal done in Congress. We're going to get the runoff done in Georgia. We will now have the Electoral College make its statement once and for all. But one of the key subtexts that's going on with the relief package is whether or not we're going to see cities, states, and counties all financed in some way, shape, or form as a result of a new package. We'll see how the retail season goes. The retail season is another way of measuring consumer confidence. And so, and we'll see how online sales versus brick and mortar also kind of, exacerbate this bifurcation in the market with respect to how COVID-19 has affected the way we shop. Our housing market's still looking good, but at the end I'll talk about debt because our housing markets are related to how we look at debt at the household level. And the data coming out are suggesting that people are taking on more debt, probably either to sustain themselves or taking advantage of low interest rates. But the key factor there is whether or not that debt ultimately, how much of it's at risk and what's really brewing underneath with respect to economic development. Because you'd say, well, businesses can take advantage and move forward. That's great. But if households are taking on more debt, what does that mean if that becomes, let's say, more concerning with respect to people's financial viability if we see a change in how much debt they have and ultimately their ability to stay current on it if the economy does not recover at the correct speed. And that's why I say here a race to recovery, because what we're really hoping is that we start recovering in earnest and structurally in such a way where debt is not an issue. Let's go through some of the data. This is my labor watch in terms of how people remain unemployed. This recession was typified by people being temporarily unemployed. You can see that big spike on the far right-hand side. This is from January 2007 forward. So you're going to see the Great Recession in just a second. But notice that huge spike. Most people lost their jobs in April and May for temporary reasons. But then as the economy continued to figure itself out with respect to COVID-19 and businesses remaining closed, that started to slowly change and people became permanently unemployed. Now, that hasn't really started in earnest until the last couple of months, but what's concerning is you'll notice the Great Recession is now very obvious on this graph, that blue hump there about a quarter of the way moving left to right, is that now you're seeing more permanent job loss than initially. So the hope was, and this is why forecast came out as quote unquote V-shaped right away in April and May, is because temporary job loss is something that is literally that, it's temporary. So whether or not you convert to permanent is one of the big question marks in recession when it is focused on temporary job loss. But temporary job loss in recession is actually very atypical. It normally comes in a permanent form because the structure of the economy changes for some time. People and businesses reassess where they're going to go next, and then we start recovering. You can see that long drawn out spell where the blue part of this graph was relatively large for some time. That's because we had a long spell of recovery after the Great Recession. But people also complete temporary jobs. They leave their job, they re-enter after being out of the labor force, and we're seeing that start to pick back up again, which is good. And new entrants that come in, high school graduates, college graduates that suddenly appear. So that rainbow color on the far right-hand side is concerning, mainly because of the darker blue. And we're seeing the fate of temporary jobs being converted to either permanent job loss or people getting their jobs back. So we're still seeing that mixed bag. We do not want to see that blue section widen, and that's the critical factor on this graph. If you look at continued unemployment insurance claims, and this is something that economists are looking at because it really does tell the tale of the recovery in many ways. Here's the US progression since the 1st of January. And this is the total number of weeks that unemployment insurance is being paid at the national level. So you see the big spike going into early May, then the fade, which is a relatively consistent gradient throughout the summer and basically through about 2.5, 3 weeks ago. But notice at the very far right-hand side that gradient is starting to flatten a little bit. So this is why the unemployment rate did not change that much in November, is because the number of people that went on unemployment insurance versus coming off was relatively flat in terms of change from week to week in the beginning of November. So these are the data that generate the unemployment counts that ultimately end up being what shows up in the newspaper for the US. Now here's the California analog, and California's picture is much different. This is why the California unemployment rate is higher than the US level. It had a flatter summer, same basic spiking in terms of job loss initially and a lot of people going on unemployment, but also the beginning of a flat stage, sort of, in November. Now we will see, and California somewhat lagged the national picture, at least historically. So it wouldn't shock me if we flatten a little bit after the US flattens, but the flattening here is not good in the sense that it does slow down recovery. If it continues to go down in trend, that's good. And that's why I said earlier, we're really looking for structural, consistent recovery in the midst of growing uncertainty with respect to COVID cases. And we'll see how this goes over the next couple of months. But this is something that's concerning economists, and one of the reasons why the unemployment picture did not change that much from October to November for the US. Here are some forecasts. Every quarter, the Philadelphia Federal Reserve puts out a forecast for the next few quarters and also the next few years. And this is what they put out about 3 weeks ago with respect to Q4, the current quarter, and also looking forward through the end of 2021. This is GDP growth. And you can see when I talked earlier about moderating forecasts, you'll notice that the numbers from the previous quarter, which is the first column on the left, has most of those numbers are larger than what the second column, the current forecast, is. And then they just added the fourth quarter of 2021. But again, the reason why we're seeing moderation here is because the beginning of the cases and the caseloads were higher than we kind of expected initially. We'll see how we deal with it. But we also haven't got a federal stimulus package, which were part of the previous forecasts. With respect to jobs growth, we have actually outpaced forecasts. And this, you'll notice here that the previous forecast had much higher unemployment rates for the United States than what they now think is true and what is likely to happen going into 2021. The issue, as I should just said in the last graph, is that if we start to see a slowdown in recovery, we will flatten a little bit, and forecasters have kind of got that in. You'll notice that the change in 2021 is relatively moderate throughout the entire year, rather than getting 1.5–2% jumps month to month, as we're starting to get those temporary job losses converted to either jobs, and mainly to jobs, but also to permanent job losses. We're going to see a slower transition in terms of getting down towards so-called full employment. And I'll show you in a minute what the next few years look like. But 2021 is likely to be a flatter year with respect to labor recovery than we saw in 2020. And a lot of that's because we're getting down to the point where there's more frictionally unemployed people still looking around. Some folks that are wondering whether they should take their jobs back. More low-skilled workers are still out of work. And all those usually mean somewhat moderated growth, but also a slower time getting back to work. This is the annual picture. In fact, 2021 looks like a little bit stronger growth, though the mathematics, and sometimes with these surveys, it's a little tricky because they'll answer the quarter questions differently than they answer the annual. But you'll notice that it's 4% now for 2021, where if you did just an averaging of the quarter forecasts above, you would not get 4%. It's actually less than that. But the bottom line is they're expecting 2021, 2022, and 2023 to be relatively moderate growth years. Not great growth years, but pretty decent. And a lot of that's because they're expecting labor market recovery to continue, where we're going to be about 4.6% unemployment by the end of 2023. Now, at the American level, or at the national level, we started this year right around 4%. So we just won't quite reclaim all the capacity in the labor market lost that this year until at least 2023. And that depends on how accurate these forecasts are. But most economists agree. And here's some other things to think about. The IMF also does not see full recovery until 2023. The New York Fed is seeing a little bit slower than what we're seeing in the Philadelphia Fed survey, though the Atlanta Fed's a little bit more optimistic. None of these economists are suggesting we're going to be back to square, where we started before COVID-19 gripped the economy before the end of 2023. 2023 will probably be the year where we feel like, okay, if everything went right, we're good to go again. But we got a long way to go before we get there. Here's a look at the California labor numbers as of the end of October, because the November numbers are going to come out in about 10 days. And you can see across the state, unemployment is still relatively high, certainly from where we started the year. But places like the Sacramento metropolitan statistical area, San Diego, San Francisco, believe it or not, the residents of those areas are actually slowly getting back to work and at a little higher speed than places like the Los Angeles metro area and also the state on average. Now, there's a couple of caveats here. One is that if you're working, but you are moving around the Bay Area, for example, it may not give you the clearest picture about what's actually going on for folks that work at jobs in the city, in San Francisco proper. But it is giving a sense of the total metropolitan area. People are getting back to work. And that's because in the urban areas, generally speaking, we have a little bit more educated workforce than, let's say, in the suburban or rural areas, with one exception, and that's Los Angeles. But Los Angeles has gotten hammered on two different vectors that really San Francisco, San Diego, and Sacramento have had in sort of partial ways, San Francisco more probably than the other two. And that's the tourism area. The summer was absolutely terrible for the Los Angeles area, but also the entertainment industry. So if you add those two together and the losses that remain in those industries in the Los Angeles area, it's still very much gripped by a slow recovery. But one of the things that's happened over the last month, and probably will also happen again in November, is the coming back of the labor force. I showed you that graph for the American economy as of November, and that increase in the number of people who were outside the labor force or new entrants that have now come in are currently unemployed, but or at least are seeing jobs recovery coming, so they want to get back to work. That has happened across the state, which is good. One of the early fears, and you can see for San Diego and Sacramento, the number of people that are either working or seeking work is actually above where it started last year. And that's because we've had a surge of people come back in. But we also may have had some intrastate migration where some folks have moved to San Diego and now are there and looking for work, or moved to Sacramento and are there now looking for work where they were some other place in California previous to that, and they lost their job and now they're looking for greener pastures, if you will, in those two metro areas. We're watching very closely the evolution of the labor force and see whether or not for California, it remains negative as a precursor of people actually leaving the state. Here's job changes across California by industry. I'm going to show you this is April, this is May. So for California, it was May that we really saw jobs tank. Then June, July, August, September, and October have been consistent recovery months, more or less, with a couple of wobbles. The summer flattened a little bit, and then the last couple of months have been relatively good. Again, far right-hand side, I just talked about this with respect to the Los Angeles area. 28.4% of the people who had a job 1 year ago in October are out of work as of the end of October this year. In other services, which are hair salons, nail salons, auto shops, et cetera, about 1/5 of the workers are still out of work that had a job 1 year ago. Even the first one here, moving left to right, farming, for California, we saw a pretty tough year. Part of that's probably fire related, but part of it's also that we've just seen a general downturn in the amount of farm labor needed this year. Here's looking at continued claims for unemployment insurance across a bunch of metro areas in California to give you a sense about how different parts of California have recovered. Here's California on average. Here's San Francisco, and this is something that a lot of economists talk about, this really big bounce quickly up and then a flattening over summer and then finally starting to get more recovery momentum in San Francisco. Sacramento, pretty much following the state average. LA, just like San Francisco in many cases, or in many ways. San Diego, more recovery more quickly. Fresno, not a whole lot happened. And Central Valley actually has staved off a lot of the big problems during COVID-19, partly because they didn't have as many COVID cases initially, but we'll see how this goes in terms of the winter surge. There's Sacramento again. I kept Sacramento there twice for some reason. Then I have the US. And notice the US is much different than these metro areas in California, has been sliding down consistently since May, as I showed you earlier. So one of the things we want all these data to turn down sooner than later, suggesting jobs market recovery. One of the things about this recession specifically is that it has not been typified by, at least not yet, a housing market contraction. Now, we're still very early in this recession in terms of turning the corner and starting to recover, but the forecast through the end of next October, basically through the major housing buying season next year, is positive across all 58 counties of California. And if you pick your county where you are, you'll see it is ranging between 4.5%, Del Norte on the far right-hand side, all the way up to Imperial at 10.1%. Most housing economists argue about, obviously, the different counties in those very particular forecasts. But the far left-hand side, which is California on average, most housing economists in California are seeing housing having a really good year next year, mainly for two reasons. One, we are expecting consistent economic recovery, especially if we have a generalization of effective vaccines. And second, interest rates are looking to remain low at least through 2021. So there won't be really any demand side reason to expect housing prices to fall. Now, it does lead to two big social questions. One is, what does this imply in terms of rental? For example, if people are now moving from rental into home ownership, what do they leave behind, and will they leave a lot of vacancy behind? And second, whether or not affordability, once again, becomes a big question in city councils and boards of supervisors, because this is pointing nowhere but north with respect to the cost of buying a home. And we already had a housing crisis on our hands previous to COVID-19 with respect to affordability. So watch for those arguments in your local cities and counties over the next 12 months. And once we start to seemingly turn the corner completely from COVID-19, whether or not those arguments become big deals. One of the things we're watching also is the so-called K-shaped recovery, meaning that recovery and momentum there has been good, not spectacular, but pretty good. But if you're a high wage worker, and even to a certain extent a medium wage worker looking nationally, which is somewhat low for California standards, where high wages are over 60 grand per year and medium are between, or middle wages are between 27,000 and 60,000 per annum per person. You'll notice the recovery in California, at least through the end of September, is stronger for those higher wages versus the low wage. And I'm going to highlight that these two in just a second. You can see that split and how they've kind of followed each other in California, where there's the low wage recovery. Well, the data I showed you before about job losses, the job losses in California remain very concentrated in relatively low wage industries. Other services, like I said, that amalgam of personal services, and also leisure and hospitality, which is an amalgam of bars, restaurants, and hotels. If you jam all those together, you're getting primarily lower wage workers by at least these standards per person, and the recovery has lagged. 28.1% in California, very close to what we saw in terms of job loss in those specific industries. Now, what does that mean? Well, one of the things we're watching is whether or not we're able to retain those lower wage workers, what it means for social services demand. This is what's so important and why a lot of cities and counties and even the state of California is asking Congress that in the next fiscal stimulus package, do not forget your state and local governments, because we have social services demands that are rising and we need to provide more services, especially for folks that remain out of work. And what that means for housing market stability, because if low wage workers are the primary renters of apartments and other units in our local areas, what does it mean when they do not have job opportunities come back at the same pace as others? And will that lead to larger vacancy rates and believe it or not, potentially the incentive for more existing units to go on market with respect to the housing market, because now I might be able to rent in the short term locally, where at very low vacancies, I really don't have that local choice, meaning if I put my house up, where am I going to go next? If I can't afford yet, maybe to upgrade. And that's the game that's going to get played in housing on one side of it. The other side is, as this lingers, whether or not we see more evictions and how the eviction moratoria that have been around the United States, including California, are able to continue without having commercial real estate owners start to really go crazy because they're not going to get as much cash flow by basically government edict. Another big deal, and this is one of the things to watch, folks, very closely, is as we move forward toward the end of the year, will the next stay-at-home orders really change the way we see our local businesses remain in place? Leisure and hospitality, bars, restaurants, and hotels are right on the front side of that because people aren't able to travel. You can't gather in a bar. You can't going to a restaurant and eating indoors is going to be a problem. We might see more job or more business losses. So these data are through the end of about 3 weeks ago, November 16. And you can see that about, at least by these data, these are coming from tracktherecovery.org, which is a partnership between Harvard University and the Gates Foundation. 31.1% of so-called small businesses that have generally less than 500 workers, but really are less than 25 workers, mainly in California. 31.1% of those businesses are closed that were open at the beginning of the year. But in leisure and hospitality, almost half of those businesses, 45.6%. So we got to watch this very closely to see if this trend continues or in fact gets worse if we don't get more economic recovery and the stay-at-home orders end up slowing us down even more. So watch for that, and watch also in retail, which is not shown here, but is another place we're watching very closely to see how many local brick and mortar businesses are at threat. Okay, and I kind of just said all this, but the key here, and this is the last point, it's actually maybe most important, we have to be thinking about the cost of doing business on the other side of this too. It's not, just to say, hey, we just need economic recovery and demand needs to come back. Demand also is going to be beset by how much it costs to continue to provide goods and services. Even if there is rising demand, will your bills be so high that it won't matter? We got to watch that and see, making sure that the state government does not add more cost on top of that in the short term with respect to more business taxes or just more regulatory environments where we need businesses to really break out of this, but we got to keep people safe, specifically in businesses where we gather together. Every time I've done this with Kshape and Kaiser Marston, I've tried to put a little sidebar thing, which I call an economic development sidebar. This time I'm going to talk about debt delinquencies, because one of the biggest issues we've been watching is that we have not seen a lot of debt issues like we saw in the Great Recession, but a lot of it's because we've had debt deferment, meaning that banks and credit unions have been relatively good about making sure, hey, if you can't pay right now, let's defer that. Well, deferment does not mean forgiveness. It means to delay the payment. And some interesting things have started to happen in specific credit markets that we need to be very cautious about making grand conclusions from these data. This is credit card delinquency, meaning that you have gone at least 90 days without paying on your credit card at least the minimum balance. And that's actually gone down. Well, part of that's deferment. It isn't because people gotten a lot better or that people suddenly have gotten more rich and they're just paying down their credit card balances and thus not getting in trouble. There's been delays. Here's home equity lines of credit. Here's student lending. Look at that deep dive. Like, that would tell you that maybe the student lending issues are over. Well, a lot of it's deferred. There's auto lending, and then there's mortgage. So one of the beauties of these is that mortgage lending, either home equity lines for credit or mortgage proper, first mortgage loans, or first loans, I'm sorry, in the mortgage portfolio, have not shown much change. And a lot of that's because of refinancing activity. So the more people can use lower interest rates and refinance, the better the debt situation is, even when those payments kick back live again. But we got to watch very quickly for abrupt changes back north when deferments end. So these data, they end up making headlines because there's such a wild change, but be very cautious in believing that debt issues are over for specific markets, especially in credit card markets and student loan markets, which tend to be the highest, as you can see on this graph, and put the economy most at risk. The reason why this is an economic development issue is if this slows down spending even more, then a lot of our local businesses who really rely on consistent spending, especially from low-wage consumers, is something to watch, and whether or not that slows down and puts more businesses at risk. Okay, so what to watch? Well, we're now going into general stay-at-home orders, folks, so we'll see if that changes our labor markets, holiday spending, and ultimately puts more pressure on our brick and mortar businesses. We're watching housing, as I said before. We hope that housing remains a consistent growth area, but that also, with like everything else in economics, there's an opportunity cost for that. How that changes affordability and ultimately the stability of our labor force later, if rental and the housing markets do not walk hand in hand for a while, that can lead to some destabilization. and whether or not we see something happen in Congress that provides a second round of relief, and whether or not state and local government get that relief before the new administration, because they're going to need it as soon as 2021 begins. We need to see how that unfolds to really feel like the forecasts I showed you before are going to be true. So Vicki, that's all I have. Thank you all for coming today. And I want to thank Kshape and Kaiser Marston again for having this series continue. And if we have some questions, we'll take them now.
Okay, our friend Leslie is asking if the internet sales increased significantly in the third quarter. What does it mean for the city general funds?
It should be positive for general funds, including the state. And but the kicker is how that then affects brick and mortar. So if we had 100% internet sales only, and sales tax increases helped out our cities and counties, that's great on the front end. The problem is that puts more of our local business or brick and mortar businesses at threat. So it has this sort of, you know, dual issue. It's kind of this yin and yang, if you will, that we want that to happen because we want to see more revenue. The problem is that it puts brick and mortar more at threat locally. But one could argue that that's unfortunately a trend that was coming, and it's just been exacerbated by COVID-19.
Okay, Kathy from Tehama County asks if you think that they will extend unemployment benefits again.
I think they will. It'll be at a smaller level in terms of any bonus, if any, but I think they're going to try to extend it another maybe 3 to 6 months. I think there's going to be a lot of pressure to do that, especially if we see the jobs numbers kick back up again as a result of stay-at-home orders. And a lot of it will depend on how Congress is looking at the mix of a new package, whether it's business focused or people focused. If they're thinking how important the Georgia runoff might be, they might want to extend those unemployment benefits and provide a little bit of a bonus as a way of in a sense, showing on both sides that they were willing to do something for households, because households vote and businesses do not. But at this stage, I think it's not going to be as extensive or as voluminous, if you will, with respect to benefits as the first round. Okay. It'll be intriguing to watch how this plays out.
Okay. Are you seeing any trends, or when might we expect some trends on earnings? Are people returning to work at the same wage level?
Generally speaking, they are not, at least what we hear on the front end. It's a little bit lower, but not significantly lower. It's not like that there's been, let's say, a third cut on all wages. You got to remember that when you get your job offer back, one of the things that is an important piece of it is whether or not you're going to get that offer at the same pay. And this is one of the things about coming off on unemployment insurance that businesses need to be very cautious of. And there has not, as a result of that, been a let's say a 10%, 15% change down in wages. The wage changes are small and negative, but what we have so far is relatively small. Now, official wage statements in terms of what people are being paid won't come out again, or won't come out for about another maybe 3 to 4 months with respect to the third quarter. And in the second quarter, we saw a little bit of give back on wages, but not much.
Okay, that's an interesting question here from Daryl. He has clients that have moved out of state, but are still working for companies in California. So does the data reflect this trend?
It does not quite reflect it yet, short of the loss of labor force, and that assumes that the labor data is up to speed on where people are residents. So what's funny about the way we look at labor data is that the unemployment rate, the amount of unemployed people, the total employment level of a local area is based on residents, not the people working in that area. Then all the so-called non-farm employment is all based on where you work. So if your employer is still in San Jose and you live now in Boise, you will be counted in San Jose's non-farm employment numbers, but you'll be counted in Boise's numbers with respect to labor force. But that should show up in terms of a way of reconciling that algebra. It should show up in a reduction of San Jose's labor force because you've out-migrated. You still have a job there, but you're no longer a resident there. And that's why that negative numbers in California, when we originally saw them dip down very quickly, we were concerned that people were leaving the state with speed and earnest. And that may not quite yet be the case, but that's basically how the labor market or the labor market data capture those dynamics. And we don't have any idea really on the ground yet. We're still kind of milling through those data to figure out whether or not it's a trend or a short-term phenomenon.
Let's see, one last question from Pete. Do the forecasts assume that the California minimum wage schedule will go forward as planned in January? And isn't the minimum wage increase going to drag the recovery down?
That's a great question. We might see an 11th hour change that, or a delay. The governor's governor, if you will, was put on by Governor Brown when the minimum wage law was passed. We might actually see that actuated before the end of the year, with an idea that it's already going to be tough enough for businesses to get back together. But Governor Newsom's in a really nasty spot because he's getting a lot of business pressure to not change anything and really try to provide the smoothest ramp back for businesses. But the problem is he's also getting pressure from a lot of household sort of consumer groups that, hey, if you don't let the minimum wage continue to go up, it's just going to put those that are at lower wages that much farther behind the eight ball if and when they get their jobs back. So that's a real nasty friction. That's an outstanding question. I couldn't tell you whether or not it's going to happen or not. There's no doubt that from a business standpoint, you could see it as an additional drag, because if you're starting to bring people back and you suddenly are facing a raise for them, it might make it marginally that much more difficult to get back to square.
Okay, we are at our time. I'd like to thank everyone for joining us, and these slides and a recorded of the presentation will be on the kshapeconcepts.com website for anyone that wants to take another listen.
Thanks, folks.
Thank you, Rob.